Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own and, however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational event. This is one in a series of events that we're doing about pilots and planning for pilot future, tax management, wealth management, all sorts of wonderful information that our pilot attendees would love to hear about, we hope. As we go through today's presentation, we encourage you to ask questions using the chat box. You are muted, but we do monitor that chat box. And if you ask a question in the chat box and we're not able to get to it, please leave your phone number as well, and we're happy to reach out to you after today's event. We want this experience to be as educational as possible. So please, again, don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to today's guests. Excuse me there. Our moderator today is Mark Seither, and he is a partner and wealth manager with Kingsview Partners in Knoxville, Tennessee. He has a Bachelor of Arts in Economics from San Diego State University and began working as a financial advisor for Northwestern Mutual. Mark enjoyed finding innovative solutions to clients' complex problems, and his desire to work with the entrepreneurial minded helped him thrive as a financial advisor. Mark honed his skills as an advisor and planner, and he looked for a platform that would better pair with his desire to work with clients needing advanced planning and specialized fixes. And he found his spot in early 2017 when he joined Trust CFO and assisted in integrating complex tax and estate planning with wealth and investment management. Since then, he is paired with Josh Saunders, who unfortunately is not able to make today's webinar, but Josh is a retired Navy and current Southwest pilot, and together they work with individuals on wealth management and tax strategies, specializing in pilots. So Mark, why don't you go ahead and say hello and make sure everyone can see you.
Hey everyone, super excited to be here. As Marche stated, I worked with a trust administration firm on advanced planning, and one thing that my co-worker and now business partner Josh Saunders and I saw was tax planning is absolutely key, and there are people who grow their wealth well, do so tax efficiently. So we're very excited to have Aaron on. Anytime we can talk to an aggressive CPA who's super savvy, we're more than happy to hop on that call.
Well, I'm excited to have Aaron here as our featured speaker. Aaron Schaub joined Keen & Company in 2020. He has over 5 years of experience in tax planning, tax preparation, consulting, and accounting. And prior to entering public accounting, he served 11 years active duty with the U.S. Navy. He continues to serve as an instructor pilot with the U.S. Navy Reserve. Aaron earned a Bachelor of Science degree in quantitative economics at the U.S. Naval Academy and a master's in defense and strategic studies at the U.S. Naval War College. And Aaron, we're so excited to have you here. I'm go ahead and turn over the time to you.
Thanks, Marche. Hey, welcome everybody. I'm excited to talk to you guys today and have some interaction, hopefully. Like I said, my name's Aaron Schaub, and I'm a CPA. And this is a second career for me. So I got to see the military side and transition to the civilian side. And it's been a fun transition and a lot of learning. We'll go ahead and get started. Basically, I'm going to go through we're going to do some tax planning ideas, strategies, and just really it's a thought process that we're going to go through today, and set in the guidance of what not to do in a lot of ways. I'm not a lawyer. I cannot give legal advice. And one thing that I've learned in this job is that everyone is different. Everyone's goals are different. Everyone's situation is different. So please, you're going to hear me preach this. Please, please, please talk to somebody about your specific situation. And hopefully they can get you on a good path. All right, with that, let's kick it off. One of the complaints that people have, I think, against CPAs is the mindset is, well, I didn't get a big refund. And the other thing is they didn't give me any advice. I push back on those things. It's like, well, if you want to be in a compliance minded where I'm going to backfill everything because I'm going to give everything to my CPA in March that's going to do my taxes, or I'm going to do my taxes in March and then I'm going to be upset with the result. What we see in that is just a failure to plan, or a failure to ask for advice. We want to help you. Like, we want you to pay less in tax, like as much as legally possible and as much as that fits your goals as a CPA working in tax. We want you to know that stuff is coming. And so if you want advice, we would love to hear from you. I love my clients that want to talk to me, that want to run things by me. The things I get really upset about is when I give them the tax bill in March and they just get really angry at me. Like, well, we could have, if you'd have called me in October or November, we might have mitigated some of that. Or we could have a plan to, hey, this is how it's going to work out over the next few years, at least under current law. So I highly recommend people, highly recommend, get a plan. I think Mark and Josh, when I've talked to them, they've got a strategy for financial management, financial and wealth management. And it's not, hey, let's get a big bang for your buck. It's not get a huge return on investment. It's mainly making a plan. And that's everything from a budget, which I would highly recommend. And then like planning for how are we going to plan tax out over the next few years, over your lifetime. So please get advice. And you need to get advice before the tax year ends. It doesn't help me when you bring your stuff in February to get upset that you can't make anything. I can make some small changes, but there's not a lot we can do after the tax year expires. Remember that paying taxes is not necessarily a bad thing. I wish I had a different system to run the government and build roads and do all those things in this country. But taxes is how we do it. And planning to pay tax is I think, better than just being at the mercy of whatever happens. And sometimes I think paying taxes, you can mitigate that risk of, hey, well, I'm going to pay a lower tax rate this year because of my plan. And that'll make you feel kind of better about life in general. We're probably gonna hit this a couple times, but be really aware of cheap advice. One of my friends and colleagues or friends and family ask me tax advice. I'm pretty quick to say, well, do you want the free stuff or you want to pay for it? And the free stuff it's going to have a little bit of thought, but I'm not going to be able to cover all your bases. I'm not going to be able to basically dive in your specific situation and help you build a plan for the future. I'm going to give you a one-off of, well, I would think about this. Good advice is not cheap, so pay for it. The same thing of tax returns. Inside our firm, a good tax plan is going to run $400 to $700. It's going to take 2 to 3 hours minimum. And I think most of the time in our situations, when we do this with clients, we save our clients at least that much of tax just by planning ahead. So just plan to pay for good advice. And Mark, you can jump in with, if you've got anything, just stop me.
Yeah, I had one question come in, which is, for someone who, they're obviously not doing they're not planning their taxes ahead of time, and they're asking, so when is a good time, or how many times should they be meeting with this, or should they schedule meetings with their CPA?
Yeah. So I would give two answers to that. One is an analogy I used to give my sailors, which is if you're going to buy anything over $500 back then for those poor young kids, you just need to come and tell me. And I would modify that to a client to say, hey, if you're going to spend $4,000, $5,000, $10,000, if you're going to make a major life shift, buy a house, sell a house, put a kid in college, if you're going to have some sort of major life shift, you should talk to an accountant before you do that. And the other one to say is, after October 15th is a great time to call a CPA. Generally, our filing deadlines end October 15th, and that begins the next tax season in tax planning. So in the fall is a great time. The only issues we ran into this year, specific to kind of the pandemic and supply chain issues, and those ongoing after effects of all that, or we would tell a client in early December, hey, your marginal tax rate's in the low 40%. Do you want to buy a company vehicle? And they may have a hard time actually finding that company vehicle. But generally, if we can talk to someone in November, then and they're a calendar year taxpayer, then that's going to give them enough time to make some changes before the end of the year.
Perfect. So and real quick, because you touched on something there that I just want our listeners also to know is you mentioned after October 15th. Give me the two stretches of time in which you're probably not going to get a hold of a CPA.
Yeah, so I'm going to tell you one, no matter how busy a CPA is, they have to be reachable. And they may put you off. They may say, hey, let's talk about that at a different time. But if you call a CPA asking a question, you should get a call back. And we'll talk about that later. The other thing to say is between February, at least right now as it stands, between February 1st and April 15th are pretty heavy seasons for tax firms. After that, it tails off through the summer, and then it picks up again in August. So about middle of August, first middle of August through the end of the middle of October are also heavy seasons. Those are when the federal, many states, they're the entities and the personal filing deadlines when they hit. So summertime is a great time to talk. Later in the fall and into December, great time to talk. Outside of that, you still should be able to get a hold of them. They still should be responsive. It's just realize that that's a more difficult season, and you're not the only alligator near the boat. So, all right, let's keep moving. One of the things I hear from people about when I say I'm an accountant is that I couldn't understand how you could do that. It seems so complex to change the rules all the time. And it's kind of boring sometimes. That's true to some degree. One of the things I would say though is it's no more complex than any other job. And since this is a pilot specific webinar, as a pilot, I think if you can understand the specifics of flying IFR, VFR, VMC, clearances, airspaces, altitudes, if you can understand that and the systems of your own aircraft, you certainly have the mental capacity to understand the basics of the U.S. tax code, especially as it applies to just a general small business owner or a wage earner. There's different types of income, and I think you should be able to understand the difference between ordinary income and what we call passive or non-passive income or investment income. You should be able to understand that, like, how the taxes get calculated, that it's a progressive tax scale, meaning that when you increase income, the next dollar gets taxed at a different amount, but your entire stack of income does not get taxed at that higher tax rate. You should be able to understand deductions, withholdings, like pre and post tax deductions. It is a really poor excuse for someone, like you could say someone with a bachelor's degree or with a really technical background, to not be able to understand this. Is like, you should be able to understand it. And so you don't have to know the exact answers to all questions. And that's where a CPA and a tax advisor comes in. If they can coach you, they can help you. You can ask good questions that they can refine those answers for. Don't let the complexity of it all dissuade you. there are some things that are probably not going to change for a long time. I don't think Social Security tax is going to change. I don't think FICA, those things that have been around 40, 50, 60 years probably are not going to change overnight. There were some significant changes with Tax Cuts and Jobs Act that happened recently. And then there were huge changes in the 80s with alternative minimum tax. But those things affected a very distinct group of people and taxpayers. But the rest of that, taxes on wages, ordinary income, like that stuff didn't change. So don't let the complexity of the situation hurt you. Just look at it as an opportunity of, hey, I've got to figure out how to beat this system, or at least I got to figure out how to understand this system and not be at its mercy. So, Mark, you got anything, or you want me to keep? I'll give it a
yeah.
pause.
Let's. We got another question in, but I think it's going to be better addressed at the end.
Okay, very cool. All right, guys. So when I talk to my clients that are business owners, and we plan for tax, there's some very, we just cannot get rid of tax. I would say, and it's like, hey, let me do things differently and it'll just get rid of tax. It's not quite that simple. If you have taxable income, if you have income that exceeds deductions, generally there's going to be a tax created because of that. If you are sustaining losses, generally there's no taxes with losses. In the current world we live in the U.S. tax code, Congress has basically allowed us to accelerate depreciation on fixed assets, and that's where really the manipulation of income, and I hate to use that word, it's not manipulation, it's just this is how taxable income gets calculated. But to back up to that, when we talk about reducing tax, one of the ways we do it is through some sort of small business. And you can call it a side hustle, you can call it a gig, you can call it, hey, this is my second job, or it's my spouse's job. But that is one of the real, just a really good avenue to be able to help, to be a tax planning tool, honestly. Now, here's the real kicker with that. If you're going to have a small business, it's actually got to be a small business. It can't be just this, oh, this is how I take a loss every year and I write off my cell phone bill. It actually has to be a small business. I can't sit here and tell you, oh, this is a small business. You're the one that's going to have to decide that. And I can give you some great tools and some reading material to look at. One of the things a small business does, however, is create income. It might sustain a loss. It might sustain a loss for several years, but it does create income. And the point of it is to make money. The point of it is not just to be this continual loss that I use to write off my groceries. So there's a difference between fraud and legitimacy. And as a tax accountant, I want to see a taxpayer come in that is trying to make money and might be having some, and might be able to take up some other benefits that come with that as being a small business owner. So it's got to be real. It can't be just just some way to write things off. So I'll start on that foundation. I'm going to give some specific instances of, hey, what's legit, kind of what's less legit, and kind of keep it pilot specific. So some of you guys and girls out there are CFIs, and you hustle on the side as a flight instructor, and you say, hey, well, why don't I buy an airplane and I can take depreciation on that airplane, and that can be my that'll be my small business. And I say that's completely legit. That sounds like a great idea. However, if I was an inspector or an auditor, one of the things I would want to look at is how are you using that airplane? So if it's 90% you're taking students up and doing flying lessons, that's great. If 90% of it is you flying to Florida or flying to California for personal trips, that's not a business expense. So it's got to be a real business, and you've got to keep track of it. And it's on the taxpayers. it's on you as the small business owner and the taxpayer to justify your reasoning, and to keep good records. So keep that in mind. One of the, yeah, go ahead.
We got a question in. Can you explain a little bit more of the accelerated depreciation aspect of owning a business?
Yes. Yeah. So let me, and I'm going to explain it by using my next example. So there are lots of folks out there that have residential rental properties. And then there's this great thing called Airbnb or VRBO or whatever site you have, where you have vacation rentals. You're basically running a hotel. Now, the difference between those two things is very significant. A residential rental is a long-term rental, and it's you as the homeowner are going to have expenses associated with taxes, insurance, repairs and maintenance. But you're not cleaning that thing every week for a new client, a new leaseor. So that's a different animal than an Airbnb, where you're basically running a hotel. If you're running a hotel, that is what we call ordinary income. It's subject to self-employment tax, depending on how it's filed. And the property associated with that, if you have if you're real property, it's considered non-residential real property or commercial property. That non-residential rental property is treated differently than residential rental property for depreciation purposes. And I'm going to step back and say, when we talk about depreciation, that's cost recovery. That's not, hey, my truck loses value the moment it drives off the lot because of depreciation. That's not what we're talking about here. We're talking about recovering the cost of the $200,000 home, the piece of equipment that cost $100,000. So because of the nature of the business and the character of the income, if we talk about an Airbnb, it's not a rental property. It's essentially a small business commercial investment. And those types of assets are eligible for different types of depreciation than just a home that you're doing a long-term lease on. So what is accelerated depreciation? Well, Congress has come out and made these rules that say, if you buy a long-term, something that's going to last more than a year in general, that you can accelerate the cost. So let's say your asset costs $10,000, your car, your truck, let's not do cars and trucks, your piece of equipment, your tractor, your cows. Because you have this asset that's going to have a long, useful life in the conduct of the business, you can accelerate the cost recovery. So for instance, there's Makers, it's modified accelerated cost recovery system. That's one way to do it. There's section 179, this is a vocabulary review. There's bonus depreciation. At this point in life, or at this point in our tax code, it's very liberal what you can fully depreciate in the first year that you place the asset in service. Meaning, if you buy let's say you buy an airplane for $100,000. I think airplanes are 7-year property. I think they are eligible for bonus depreciation. And so if you're using that thing 100% for business use, you can take the full $100,000 as a deduction in the year you place it in service. For an Airbnb property, let's say you repave the driveway. Let's say you put in a sidewalk or a fence. Those type of capital improvements are eligible for bonus depreciation the first year. I'm going to put a little disclaimer on that can change year by year with Congress's law. So consult a tax professional when you're thinking about that. Mark, did I cover that kind of, or do I need to go?
Yes, and we had one follow-up, and this one, I mean, it might be a little technical, but I think it has a good broad answer, which was, are there situations where you don't want to take accelerated depreciation?
Yeah, and that's where I'd say this is where you need to talk to a tax professional, and really, because your goals may be different. I can think of one instance specifically where we had a taxpayer in they were doing a startup business, and they had very little taxable income. They did have some, but they knew that in following years, they're going to have a lot more. And so what we did is we saved that as much depreciation as we could. We took the minimal amount of depreciation in those low income years and saved it for when it would be taxed at a much higher rate. So each situation is different. Each taxpayer's goals are different. Consult a tax professional and in helping with that. So, hey, one thing I'm going to mention too is that there is an administrative hassle to owning a small business. And if you're pursuing it solely for, hey, I want to write off my cell phone, I want to take a tax deduction, that's just, in my opinion, it's just not going to be worth it. It's going to be more pain. It's going to cost you more in tax prep. It's going to cost you more in paying penalties because you didn't file your franchise tax return on time. Owning a business is onerous, and it can be very profitable. It can make money. It can be a great way to manipulate income through the years, as long as it's legitimate, meaning it's got to be a legit business, and that's going to take time, effort, and it's going to cost you more than just money. So keep that in the back of your head when you're thinking about these small business things.
Are you saying you can't just buy a property and like you're good? That's it. You just let it go and it just makes you money, right?
It's yeah, you can try that. I'm sure it works for some people. I've not found it yet, but
well, if you find that person, let me know.
It's got a money tree on it. That's what it is. When you have the money tree, you're okay. Yeah, we went over the maker section 179. Those are, and that's sometimes just a great thing to just educate yourself of, hey, how is section 139 apply to me when you're talking to your CPA or tax professional? What's eligible for depreciation? One of the things we found out of when you have our high income earners that have small businesses, that, hey, if you're going to pay tax in the 40s, low 40% marginal rate, that, well, maybe it is worth buying a company vehicle. Maybe it is worth, let me think of something legitimate. Hey, I'm going to get a new phone for the business. we're going to refit the office with new computer gear, because you can think of it as a government coupon. Like, the government coupon is so big that it just makes a lot more sense now to spend that money. Let's roll the next thing before I say something I regret. Okay, so entities, LLCs, the most popular thing in the world. People get one just to have one. So what kind of entity is best for you? I'm not a lawyer. Recommend you talk to a lawyer in that regard. What I would say is that what entity you pick and how that's treated for tax purposes are two different things. If you have a limited liability corporation because you want that corporate veil of protection, great. We can get that thing taxed as a C Corp, as an S Corp, as a partnership, as a Schedule C. That doesn't matter. However, the end state's also super important. There are, like, right in this time and age right now, there's some small advantages or some big advantages, depending on how you want to see it, of C Corps. That there's this created through the pandemic. I think it's created through the pandemic legislation that there are some special breaks down the road for a certain flavor of C Corp. And so the end state's very important when you talk about that. Hey, how do I want to divest this in the end? How do I want to grow this thing? And what I would highly encourage people is to start small and start with what you understand. If I can get really frustrated at lawyers sometimes, like, oh, you should totally get an LLC and elect that thing as an S Corp and go at it. And you just put an immediate $1,000 burden on your taxpayer by doing an S Corp. You're going to do a separate tax return. And then if the owners are providing services, you need to run payroll. The administrative burden can just be a very steep curve and create a lot of cost. It may be the right call, but that's something that both the lawyer and the taxpayer and the accountant all need to have a conversation about. So end state's super important. How you tax it, that's a great conversation to have, but don't start fretting of, oh, well, what kind of entity do I need to have? That's something that's generally coachable and just need to have the end state in mind when you're doing that. Mark, you got anything?
Well, I was going to add one point there because we did have a question come in that you can address after my one point, which was does an LLC prevent lawsuits? And this is before we let Aaron handle that one, did want to make a statement of this is a great opportunity for you to have your CPA included in the conversations with your legal counsel, because these all interconnect, right? And if the, like Aaron just mentioned, like, hey, I mean, if the lawyer says, well, just do this, right? The CPA might have some input, and vice versa. The CPA might have some like, hey, we could do this, and the lawyer might have some other strategies in mind. So a guy like Aaron, he's a great guy to have talk to whoever is providing legal counsel or your CPA. He should be on those calls when deciding how to form those, and also just making sure that it's a legit business, right? So, but Aaron, if you wanted to briefly touch on that, does an LLC prevent lawsuits?
Yeah, I'm not a lawyer, can't give legal advice. I remember asking a lawyer specifically, touching on businesses that have just to keep a lot of cash in the bank. And I said, well, if that business gets sued, is that cash going to be subject? Could you lose that cash? And there was some hemming and hawing. And his kind of landing point was, it's really going to be about insurance. If you get sued, please, I hope you have insurance, would be my thing. That much like electricity and in taxes, the path of least resistance is usually the taken path. So if someone's coming after you for something, then if there's an easy way out via an insurance payout, then that may be. I would highly recommend having insurance and then talking to legal counsel. So I'm not going to say too much on that, but remember having an entity, having an LLC can be a really great thing for a business owner. Whether you need an LLC or not, whether you need some sort of entity, don't just automatically assume, oh, I've got to have this because I have a business or I've got a piece of property. You may not need one, and that's where you need to talk to legal counsel. And just to have an entity, I know specifically in Texas and in Arkansas, it's $150 a year just to have an entity. So if you get to just to have a piece of paper is going to cost you something. So don't just default to, oh, I should do this and it's going to work out. I will say some of the other instances I've seen where, hey, I bought my house, my personal residence under my LLC, and now my insurance agent says I have to have a commercial policy. So I'm going to pay more for insurance because I'm trying to shield this thing from something or whatnot. So it can get really complicated really fast. Highly recommend a lawyer. And it's all about your goals and what the end state is. So.
And one story on that topic was I have run into someone in the past who misunderstood the use of the LLC, right? You read something and they were a DIYer, and they had for all of their asset planning and revenue diversification had just done different LLCs for every single one, and ended up with the cost of the tax filing for the LLC. They didn't really account for that, or they thought that's just how it had to be done. And so this is one of those things where it's like most professionals, any good professional is gonna, they're gonna answer questions, right? They're not gonna say, hey, you have to clock some time and cut a check before I give you the basic information. If you have questions, we highly recommend. You may not be engaging them for ongoing services, but at least ask questions. Most professionals are more than happy to provide some sort of insight in that arena.
Yeah.
But we'll kind of shifting to the next topic, because Aaron, we talked about planning and making sure that people have a a plan to diversify taxes, understand the tax code, get everything they can out of it, understanding the different revenue streams and what's a business, what's not a business. Obviously, the entity side of things is highly important too. How should people move forward if they're either vetting their current CPA, maybe they don't have a CPA, maybe they're having that realization that their dad's golfing buddy who's retired is not the most aggressive person to be a CPA. How should people move forward in this?
Yeah, so I would tell you that the industry, or certainly the tax accounting profession, is aging. So we are looking for good CPAs. The embrace of technology is not uniform. It's not uniform. The IRS does not come out and say, hey, you all have to do it like this. They have come out and said, hey, you've got to e-file. That's been about it, really. So here's some kind of, you can see that on the slide, my basic advice of, like, they should call you back. Any respectable business owner that is reached out to, that you should get a response, email, something. And that response may be, hey, we're not taking new clients. I'm sorry. I don't have anybody to recommend, but they should at least contact you. When you're asking them advice, if you're asking them off the cuff advice, they're probably going to be pretty cagey. And so don't expect them to give away the farm in a 5-minute phone call of, hey, what about this? One of the things I want to insert in here right before I tell you the next one is, if you're asking for, like, hey, friend XYZ, what CPA do you use? What do you like about them? What do you don't? Ask that advice of people that you want to be like. So if you want to be, the word super aggressive, when you use aggressive CPA, that sounds like fraudulent, at least in my book. I'm aggressive meaning, hey, let's think about this beforehand. That's my aggressive stance. I would ask friends that you want to be like, hey, who do you use? And then I would also look for that CPA and that tax professional to help you follow the law. That they should be somewhat the experts in, if not understanding and interpreting, but at least being able to find a good answer and find some good research to help you follow the law and the US code. So look for someone that's not actively trying to put it to the IRS. Like, if there's just active contempt for the government, I get that that's kind of a thing to do these days, but we have to work hand in hand with the service to some extent, and it cannot be this, oh, I'm just gonna abuse and fraudulently file taxes. You want someone's gonna help you follow the law, because if the IRS does get teeth, it's gonna be really painful, and you wanna have followed the law so it's not painful for you. You should ask them, hey, you can ask them, can I do my own taxes? And get some coaching on that. Anybody who's any good in the tax profession community, in the tax prep world, has enough work and probably doesn't want any more mediocre work. They would want more good work, profitable, clients fun to work with, clients takes advice. They want more good work, but they don't want a once a year 1040 that's I gotta send 8 emails to get information out of. So don't be afraid of saying, well, I could do it. Could I do it myself? They can help you make that decision. It should not be cheap. You get what you pay for. I think that you can get overcharged. I think that's it's probably a rarity. And a lot of firms charge a minimum fee kind of just to get in the door of, hey, if you want to be part of our team and have access to our team, then this is what the going in price is. I will say that every client that I know, that I work with, that utilizes our services beyond tax prep, tax planning, payroll, bookkeeping, it's worth every penny to them. So when you're in a situation of, hey, I have a small business, I have other needs besides just preparing my individual tax return, you really need someone on your team. And I don't know if there's another slide there of like, hey, this is also, these might be some good triggers of when you should get a CPA. Marche, I don't know if there's another slide. Oh yeah, there you go. So some people ask me, hey, should I have a CPA? And I pitched this around the office to a couple of my colleagues and came up with some good kind of landmarks, if you will, that if you've got any kind of business rental farming activity where you're filing that schedule, like I would highly recommend consulting a CPA. If you're getting a K1, if you don't know what a K1 is, don't go buy public limited partnerships. Please don't do that. Yeah, there's my free investment advice. Mark, I hope you're not selling those. So if you've got a huge tax schedule where you're buying complicated investments, probably need a CPA. If both spouses are working, if you both have full-time jobs and you got kids in the home, you probably need someone helping you. In a lot of different states, especially if you've got a disabled kid or you're adopting, there's special tax credits go along with that. If you're adopting, there's some federal tax credits that can go along with that. So again, a great time to consult CPA. And then I would highly recommend consulting a CPA if you're if you're going to think about the future. And it may be hey, you don't need to talk to me right now. Come back to me in 10 years. Or, hey, yeah, we can do your 1040 for you. If you got any questions, give me a shout. It doesn't have to be this ongoing expensive relationship, but you're probably going to want someone who's going to be familiar with you. And they may not be in the same state or side of the planet, but at least you have someone to reach out to when you have questions. Let me see if I'm going to look at my notes real quick and just see if I got things covered.
Yeah, I had a question come in. So someone was asking if they feel as though their CPA has not been aggressive, if they shift CPAs, are they able to go back and refile previous years?
Yes. In general, yes. It becomes a little more complicated just to make sure we get the right forms and things. One of the things I do with some clients is, hey, send me your last 3 returns and let's look through them and see if they missed anything. I can tell you just recently we did that for a client and we're going to get them about $100 grand of tax back. And I'm pretty compassionate to, you don't want to throw that other CPA under the bus that he or she didn't do their job, but it is complex enough. And you're also running a business as a CPA of, hey, I've got to check other people's work. There's some level of risk you assume there with other people working for you. So it was frustrating in this instance that there was basically a box checked and probably a conversation between the taxpayer and the CPA didn't happen. But we did catch it. It's going to be painful to get it back, but that juice will be worth the squeeze, as you might say. But yeah, you have 3 years to go back and file returns. And if you're a business owner and you're paying payroll right now, there's some very significant tax credits available through through employee retention tax credit. And so that's something that we're seeing currently. I know it's more of a current day issue of this is an issue that we're seeing. And but yeah, in general, you can go back, you can file amended returns, get tax back if you need to, make other elections. Some things you can't go retroactive, but most of it you can.
Now I had another question come in. I'm sure this is a piggyback because you explaining that story of getting 100,000 back. Probably this person has this in the back of their mind. What sort of things avoid being red flagged by the IRS for an audit? Because audits happen, right? I mean,
yeah.
And I'm speculating, but I'm thinking this person might be thinking like, hey, if all of a sudden the IRS owes me 100,000, am I gonna have to go through audits? Like, what's going on?
Yeah, so there are some tricky professional ethics things about being a CPA. Basically, I can't give you advice based on whether I think you're going to get audited or not. There's some great articles about there of, hey, who gets audited? And high income earners get audited. People with small businesses get audited, like Schedule Cs get audited more. And so I would highly recommend the internet to you to read some of those. I can say with a lot of certainty that I have maybe one or two clients that got audited in the last 5 years. That's not a particularly big client base, but huge income shifts, I would say. If you were making 200 grand one year and you're making 100 grand the next, if you were making 50,000 one year and $1 million the next, that might help. One thing I would really recommend, or highly recommend, that if you're doing things the right way, you really don't have anything to worry about. And this is kind of some bigger picture, just business advice. A buddy of mine who does some business evaluations was saying, think about if you're going to come in and buy a business and that owner says, hey, well, you need to trust me. However, here's my last 3 years of tax returns, and I didn't do things quite up to par. I deducted a lot of personal expenses in there. I did things, well, it's kind of shady gray, when that means fraud, by the way. But you're supposed to trust me. And so if you're doing things the right way and you've got good help and coaching through a CPA, like, that's going to be your best defense against any kind of audit. And it's going to just help with other things like, hey, when I don't want to divest this business, it's going to be a lot clearer. It's going to be, the value of that business is going to be more transparent. And it's going to communicate a lot to that buyer if you're in that situation. So if you're doing things the right way, there's not a lot of, you can still do things the right way, and the IRS can come up with an opinion that you don't like. I'll say that, then that's happened. And you can get audited, and at some point you say, you know what, I just give up. I can't, it takes too much time, it takes too much money. I will pay whatever the bill the IRS has. So it's not so cut and dried of, I get audited, they give me a bill, it's over. There's a lot of cost involved with that. So try to do things right, and that'll save you a lot of pain.
Which, and I do have another follow-up question to that that just came in, but this does kind of go back to finding the right CPA, which is also, comfort level, right? Comfort level and trust, because we have in the past with some of the advanced planning, sent someone to, someone's direction, and they basically showed that client like, hey, here's a strategy, highly probable scenario that we get audited, and here's the cost of the audit, right? Because he just to prep the person, right? Like, just to prep the person, like, I'm not saying you're going to get audited, I'm just saying that this type of planning, it wouldn't be a shock. And for that particular person, they said, that stresses me out too much, I don't like the costs. So, and so it was up to them. And he said, like, well, you're free to pay the tax bill. And this is one strategy, but just so you know, here's, and so that level of honesty and aggression is good to understand when picking a CPA. And the other follow-up question that came up was, if I have a business, if I've had a business that I'm going to be shutting down, is there anything in particular that has to be reported on your taxes when you shut that down, or do you just stop filing?
Yeah, so great question. There would be some follow-ups to that, like, well, are you just shutting down for the year? Are you going to sell it to somebody else? Is it going to transition, or is this just done? There are some specific things you have to do, and don't ask me what they are right now. I can tell you that specifically, you can file some paperwork. If you're in the state of Texas, for instance, you can file some specific paperwork to say, I'm just dissolving this entity, and then I'm not going to pay the franchise tax bill anymore, and we're done. Depending on what kind of entity you are filing as federally, there may be some paperwork you need to file and include with your tax return. So great time to consult a CPA. I was trying to think of anything else. There are some specific things you need to do, and they are best done beforehand. They are best done not after the fact. So
perfect. Let's see. Do you have to work with a CPA in your state, or can you work with anyone across the US?
Generally, you can work with anyone across the US. There are some geographic, if you're a complex situation, we had someone reach out recently, said, hey, I've got to file Delaware franchise tax. And we said, no, can't do that. We're based out of Arkansas. We know nothing about Delaware franchise tax. You may find that I'm going to have the most help nearby. But if you're a pretty simple situation of I'm a federal only filer, or I would say 95% of the time, general situations, most people in most states can help you. So don't be afraid of a tax firm that's in a different state. What I will say from the perspective of the preparer, what is most helpful is if I can get access to your team. And so if your financial advisor, your lawyer, hey, this is who we work with a lot. And then when it's time for me to get, I need your dividend statement, I need your trading statement, whatever, as a preparer, it's super helpful. Hey, I'll call Joe, Bob, whoever. They're going to get me that statement directly. I don't have to either mess with the taxpayer. I don't have to wait on someone else. It's just super helpful that way. That if there's a team and everybody has an understanding of information sharing, you're going to be in a good spot.
Well, I hate to break in here, but I think that's about all the time we have for questions. And I want to thank Aaron for all the great information you've shared. Thank you, Mark, for moderating. And once again, I will say to our attendees, this is one in a series of webinars that we are putting on for pilots. So we can't wait to have you attend any one of those coming up. And here at Advice Chaser, we're all about helping you find an advisor who's a great fit for you and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and click on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming. And we will see you at another webinar very soon. Thank you, everyone. Goodbye.